Good morning, traders. Today is September 10th, Saturday. This is Brad Matheny. Let's get started with the weekly market update. We're going to start today with a general overview of what I see happening in the markets leading up to the end of the year, early 2023, and what's happening over the next few weeks throughout September, October, November, leading up to the Fed's rate decision in September and, of course, October, and what's happening in the global markets overall. We're seeing a general downtrend in major markets. We will look at that in the extended phase of this research. But this is the IYT, and we're paying attention to the IYT, the Transportation Index, simply because it leads the market by about 4 to 6 months on average. We've seen a bit of a recovery here. This was the Fed expecting, the traders expecting the Fed to pivot. The Fed may or may not pivot at this point. They still have room to go, and they need to tamp down inflation, but we're seeing a very strong extended pennant formation. Now, I've drawn these lines here, and I want you to pay attention to these levels. We have an extended topping pattern across these highs. I've drawn it across these middle areas, which is the weekly chart highs across closing bars. So we have a pennant formation that ends out here in March 2023. Then we have an interim pennant formation that ends here, potentially here, if it moves off of this lower channel. So this would be November, and this would be October 10th. We're in the midst of a broad consolidation pattern, which means the markets will likely attempt to consolidate within these ranges over a period of time. So you can see from a broader perspective, we have a wave A, B potential to here, C potential to here, E, and then possibly some breakout, either up or down. Okay, now from an extended pattern here, we've got an A coming down to here. We do not have a B up to here yet, which would be likely, could happen in the next move to this from here up to here. Then we would likely see a D and then potentially an E breakout move going outward. So now we could break up or down. It really all depends how you're counting this. So let me get rid of these lines here and do this all over again. From a standpoint of a downward cycle here, if this is our A move into the pennant, then we would likely see a B, C, D, E, meaning it would break down. So from a broad perspective here, we would likely see a downward break, and this is why I'm drawing this support level in green. We need to be very cautious of this support level, and I'll extend this out moving a little bit deeper. So from a longer-term broad pennant formation, we have a very severe risk of a potential downturn. Now, if we ignore this downturn here and start the pennant formation from here, A, B, C, D, E, somehow to the upside. Now, maybe not this high. Now again, this level becomes a very critical level here for us to determine, because this pennant formation would then rally to this pennant formation or this resistance channel. And if it did get above here, then we could see some sort of a recovery phase, possibly. Let's look for support and resistance around gap. So I would probably say right around here. Potentially right around here would be a fairly strong resistance area. The pre-COVID or the post-COVID peak back here, the support level off of these lower gaps here, the rally through here, the reaffirming support here, the midpoint support here. Then we have a broad support level here before a big breakdown. So I'm calling this a support and resistance channel, and you could almost pick the closing or the opening price right here on this bar, right there, as the key level for support and resistance on the IYT, as a key indicator that we could see some resistance in this channel if we get into a breakout. So understand that we are looking at the very strong potential for a double pennant formation setup. We have this broad pennant formation in yellow, which you can see off of these lows. And we have a tighter pennant formation here in green. So we're likely to potentially see a a formation that rallies up into this area, maybe up into this area, and then moves back down into this area and attempts to form a deeper move to the outside. So this intermediate pennant formation may prompt a bit of a rally through the end of the year. It's looking like that's the case. And then the broader pennant formation, if we get a failure at this point, could come back down, reestablish this trend with an A, B, C, D, E move to the downside. So understand that this is what's likely to come, and now I'm showing this to you, and this theoretically is predicting what's going to happen all the way out into April, May, June of 2023. Now let's take a look here at the longer term picture for this critical support level, because I believe these two support levels, which is pre-COVID in the 2018-19 area, are going to become very, very critical out into 2023. So understand that we're looking at a fairly substantial upward move. When we take a look at where the IYT is right now, you're looking at about a 9 or 10% upward rally. But ideally, we're looking at this, let's call it 208, 200, and potentially down here in this 190 level as critical support, which is back down at near these lows. Okay, so let's take a look at the ES. Now, my ES chart is a bit more convoluted and tough to read, but understand that it's the same setup, okay? It is exactly the same setup, and we're in this sideways consolidated formation, and we're looking to potentially see some sort of a breakout, an extended pennant formation, and we're basically going to see the same thing across every chart that I'm showing you right now. So in the ES, we have the same setup area. We have the same green area here, which becomes critical support. It's right above the COVID highs. Then we have this midpoint area, which I've targeted as a deeper low many, many months ago. Potentially, if we were to see a wave 4 correction, again, this is a deep wave 4 correction, potentially forming a bottom, which could happen. This is now out into November 2023. So ideally, when we spread this out, ladies and gentlemen, we have the same type of pennant formation. We have a broader, extended blue pennant formation, and then we're getting into a tighter pennant formation down here off of this current move. So we understand that we're very, very likely at this point to see some sort of an upward move, potentially maybe not up to this level, could be up to this level, maybe just down to this level here, whereas this would be our A, B, C potential move, and then maybe a D, and then maybe an E coming down even further. So we need to see how this plays out. Right now, obviously, these pennant formations are playing out to roughly October 20th through 25th. So let's say between the 15th and the 30th of October of this year, where we may see things continue to slide sideways. That means we're looking at another 6 weeks of tight, narrow ranging. No real opportunity until we see how this plays out and how the actual pennant formation breaks. Let's take a look at the NQ. Again, much more convoluted, a lot going on this chart, but I want you to pay attention. Well, let me keep it tighter. So understand that, pay attention to the lines that I'm drawing over here with this pennant formation right here. Okay, this is, again, the same setup, the same pennant formation. We have a deep A move coming down to here, a B move to here, a C move to here. We would be E, and then a potential breakdown. So ideally, this is what's taking place here with regards to the NASDAQ, is we are getting into a very deep, try to pick a different color, very deep downward pennant formation, which may be the end of this wave. So it really depends on how we count it. If we count A, B, C, D, E, then we're looking at deeper downside potential. If we count it as A, B, C, D, E, then we could see some sort of an upward recovery. And let me modify this as a potential green color. And so we're looking again at early November, end of October, early November for an apex flag pennant formation on the NQ. And remember, this sets up a very critical move. We could be looking at a, and I'm going to show this to you on a weekly chart here. We could be looking at a move upward. Ooh, way too tight. We could be looking at a move upward, back up here, which would be essentially an ABC move to the upside, possibly targeting this 14,200 area, or we could be looking at a big breakout. But either way, we're looking at this move happening sometime between October 15th and October 30th, and this plays very well into my cycle pattern. So we're going to go over that here in a bit. So again, gold and silver are likely to be able to ramp up off of recent lows as we channel into this fear, not knowing what's going on. We'll likely see some sort of a Christmas rally in the U.S. markets. The U.S. markets are looking fairly strong. Cyclically, from cycle patterns, we come back over here, spread this out a bit, and take a look at our cycle patterns back over here. Sorry, my PC's running a little slow, but it should be moving. So we've just ended a cycle pattern off of this low. Now we've started another cycle pattern that ends right out here on November 15th. That's very, very close to our apex pattern here. So we're looking at potential. You can see we had a cycle low back over here. We had a cycle low back over here. These are end of cycle periods. End of cycle periods are important because they can prompt major changes in direction. So we could see this continue to move through this cycle pattern and eventually sometime right over in here reach some sort of an apex with the cycle, setting up what could be a very big breakout range. And I'm trying to warn you right now that we have to stay relatively cautious of the sideways activity. Understand that on the NASDAQ here, this represents a move of about 4% to the upside, then potentially 4 or 5% to the downside, then possibly 3-4% to the upside. So we're going to potentially be in a very, very tight sideways rotation for the next 2 to 4 weeks. If we do get a Christmas rally breaking outside of this range, then we start looking at these previous highs, these support resistance areas over here, and eventually possibly up here. And this would be our area. If we do get some sort of a Christmas rally from this point, then we start looking at these peaks back in this area, 13,620, potentially a little higher, or back up into this area, 14,800. And this would be an area where we would likely see a B, C move to the upside. And this would break out of this pennant, meaning this pennant would still be valid, setting up potentially as previous support and resistance or future support and resistance. But the reality is that the upside, any upward breakout would technically negate this, but this support and resistance level that I just extended out here would still be valid, and that is the apex area. Okay, let's take a look over here at the trend indicators for the rotational modeling system. Nothing has changed last week. Everything is still the same. The NQ is bearish. The ES, YM, industrial, transportation, and SPY are both long-term bullish, and short-term bearish, meaning that we're very neutral trending right now. We do not expect any real big trends to take place. We're getting mixed signals. The Nasdaq is technically still bearish. Gold and silver are still bearish. They're struggling to find support. We'll take a look at those later in the more advanced version, second part of this. And oil is neutral. Oil is likely to attempt to move downward. Let me explain this to you. We're having a demand reduction in oil. China's locked down 85 to 100 million residents because of COVID. Europe is moving into wintertime with extremely high energy price issues. The U.S. markets are waiting on the Fed. Right now, I'm going to tell you that, in my opinion, supply is, or demand is diminishing for oil. And depending on what happens throughout the world, we could see oil break downward, possibly break down into the $60, $62 area. The next range we're looking for right now is around the $76 to $80 area, right in this area. So this is the next range. We've seen a pretty solid breakout. We've broken through this recent resistance or support level. The next phase for oil is going to likely be to move downward, as I've drawn here, off of this apex. And it could come, like I said, in the middle of October or November as demand destruction continues to play out. Understand that we had this ramp up in oil. We had everybody moving post-COVID into kind of an excessive phase. Now the Fed, global central banks, war in Ukraine, and China's continued issues to curb COVID are really creating a decreased demand issue for oil. So we'll see how it plays out, but likely it's going to continue to melt downward, possibly into this 60 to 62 area by the end of the year. Okay, let's come over to the 401k retirement gauges. Nothing has changed this week. We're leaving everything exactly the way it is. We are watching bonds. Bonds have been melting a bit lower. We need to watch this potentially for a breakout, which would cause us to eliminate our bond position right now. We have a 20% in bonds in the extended allocation level, 15% in the alternate allocation level. We're holding 40% cash, 15% stocks. So remember, you're trading very little with your allocation right now into any stock trades that you're taking. And we have 25% in metals as a hedge. So we're using essentially cash, metals, and bonds as a hedge position against stocks. And things are not likely to change unless bonds really break out to the downside. So we are not changing anything. The rotational modeling system is still very weak. My cyclical patterns, which, let me see if I'll show those to you in the second half, are suggesting that next week we'll see a little bit of upward trending, Monday, Tuesday, Wednesday possibly, and then sideways into Wednesday, Thursday, Friday. And then that leads us to the Fed on Monday, Tuesday of the following week, the 20th and 21st. And that's likely to change things. My cycle patterns are saying that the trend could be broadly downward early on the 20th, the week of the 20th and 21st. So we're really preparing for a big change here. Now, let's go over the custom charts, some of the custom charts here. The FANGs index is trying to find support. You can see the pennant formation set up here. This is, again, think of this pennant formation that you're going to see throughout almost all the charts here as the real apex. And this is coming, again, this is going to be in October, mid-October to early November. We're going to reach this flag apex, and we're going to be looking to see what the markets are telling us. If it's breaking downward, we're looking at these COVID lows or 2018-19 highs as support. That would put us right around this 100 level, a little below it, right down here in this area. If we find support in the U.S. markets and we get some sort of a rally, we have to be very, very cautious of this unwinding, because an upward phase here, an upward rally phase here, may be fairly short-lived. It may last into November, December, maybe January, depending on what the world is doing, and we could be looking at kind of an A, B, C move downward, meaning this could be just a corrective wave 2 to the upside. So we've got to stay very, very cautious of whatever upside trend is coming, if it comes. we don't have any real indication yet that it's going to come. Next, we have the U.S. stock market index. You can see again the line across this area here. You can actually follow a line across this area. I'm waiting for this potential new low here to confirm. We do have a resistance area here, which is playing out very solidly. We need to see how this plays out going forward. But you can see a very strong pennant formation coming across here. And this is, again, playing out in all the markets. It's happening, although you will see in the smart cash index, we're actually setting up a very deep price pennant, almost off of COVID lows. So again, in the U.S. market, we're looking for support. We might see a rally back up into this area. It's only a 4 or 5% rally at this point in the smart cash index, or excuse me, the U.S. stock market index and the FANGs index. So we have very limited opportunity to the upside. We may see it break out a little bit up into this area, which might double it to a 7 or 8 or maybe 9% rally potential in the U.S. markets. But again, we don't have any real clear indication that this upward trend has any momentum yet. So we have to stay extremely cautious. And that's what I'm trying to tell you, everybody, right now. We have no real clear direction. Taking a move in any aggressive position could see a 4, 5, 6% rally, but understand it is not, in my opinion, not the right time to be aggressive with your retirement account. It is okay to be trading your 10%. Remember, 10 or 15% over here. You can trade all you want with very limited risk, with very limited downside on this allocation of stock allocation, 10, 15, 20%. But keep it very limited. You do not want to be very aggressive right now in this market. Next, the Smart Cash Index. This is the one I told you that if we get a breakout below this level, this 140 roughly level, we are looking at a very deep low potential down here, which would put us at a very extended flag formation. Right now, you could almost draw a flag across here. I'm not going to, because we keep testing these new lows. We had a new low just last week in the Smart Cash Global Index. So ideally, what we have here, ladies and gentlemen, is an extended downward trending phase, which may end up retesting these COVID lows and setting up a very broad pennant formation, which could be very, very interesting, because that would indicate that we would have some sort of a move back to the upside, and then another move. It would basically be A, B, C, D, and then potentially break out to the upside. And that could be 3, 4, 5 years out into the future. So right now, everything is looking very, very bearish. We do not have any real strong momentum to the upside. Next, we have the metals index holding above support, pretty much life or death right now for metals. Very likely that metals are going to see some sort of an upward move. We had a big move in Bitcoin on Friday. I called that perfectly if you were following my research. What we're looking at right now is, again, metals are in a do or die scenario, holding above this support level. We need to see this breakout happen, and this breakout is really only a few weeks away. This is a weekly chart, so we're talking 3 or 4 weeks away. We're going to get some sort of a metals breakout to the upside or break down, meaning that this is really an extreme low for metals right now. Both gold and silver, platinum, palladium are all likely struggling to try to find support as we see what's likely to happen over the next 2 months. And these next 2 months are going to be critical, which is why we need to stay actively hedged. Getting into or out of, let's say getting out of our hedge position right now could be one of the worst moves that we have right now. Protecting more capital, moving capital into cash. We'll see how the U.S. dollar holds up. It's been holding up quite strongly, which has been one big benefit for our cash position, which we've had now for almost a little over a year, actually. We've been holding at least 40, 50% cash, and now we're holding, we were holding up to 70% cash at one time, but now we've diversified a bit off of these lows. We need to see how metals hold up and whether fear starts to creep back into the market. The valuations index is really weakened. You can see that this tells us that the buying we're seeing, the support we're seeing in the market has not really prompted any big upward move in valuations. Valuations, the way I look at valuations is that think of this as the efficiency of our engine to drive future expectations. So you could have buyers coming into the market or sellers coming into the market, and you could see various trends through these custom indexes, but the valuations index shows me whether or not that buying or selling activity is actually moving the needle in forward valuation expectations in any way, shape, or form. You can see here from 2019, we had a broad upward trending, meaning that we were expecting the buying that was taking place in end of 2018, 2019 to prompt upward valuations levels within the global stock market. We have, since the peak levels here in June, July, August of 2020, seen a declining valuations level. This means that traders are not expecting to see upward appreciation of the stock market moving forward. And recently we've seen downward declining trends. So I'm thinking we're going to see a kind of a malaise setup, a sideways consolidation, almost a go nowhere trend. Next, we have the commodity to gold index, which is mirroring the valuations index, kind of just moderately trading sideways within this upper red range here. Still quite bearish. Remember, we had some movement up here a couple weeks ago off of this trend, and I warned you that it would likely roll lower. I still see us in a broad unwinding phase, and I don't see any real opportunity yet for us to become very aggressive. And next, we have the volatility index. Volatility index is almost perfectly illustrating the flag formation between this magenta line and this red line. We're still in moderate bullish trending territory. As I mentioned to you, anything above 6, 7 is moderate bullish. So let's say 6, 7, 8, maybe 8.5, 9 is moderate bullish. Not anything to get super excited about. It would be, now understand that if we were at 6, 7, 8, 9, and we were in an upward trending commodity cycle and or an upward trending valuation cycle, okay, maybe I'd start to get a little excited about this. But because we're in a downward trending cycle and we're in this tightening formation on the volatility index, I see this as consolidation. I see this as an A, B, C, D, possibly forming even tighter consolidation trends. So this is a weekly chart, and if we were to look at it, we could call this an A up to here, B down to here, C very clearly up to here, possibly a little bit higher, meaning a double C top formation here, and then an E formation potentially breaking to the downside. We've just got to wait and watch, ladies and gentlemen. There is no clear trending yet, and we've got so many pennant formations and flag formations setting up in an unwinding cycle phase with global market contagion events kind of dancing around the fringe edges. My advice to everyone is to stay properly hedged and stay away from risk until we have a very clear trend channel going forward. Okay, this was a little long, but it's very, very good. Now let me show you back over here, Bitcoin. Bitcoin has done exactly as I stated. It's been a tremendous little bounce here. If you recall, I highlighted with my predictive modeling system that we had to get down below the 18,800 level to set up a very quick momentum base. I called it happening between 9.6 and 9.8 roughly as an inflection point. We had a very strong rally phase. The next phase of this is going to be possibly up to the 25, 26,000 area, potentially with a little bit of consolidation, and then potentially up into the 30,000 to 32,000 level. That's going to put us right back into this consolidation range, roughly right across here. And that's going to probably put us into a new downward cycle phase to reform support back around the 25,000 area, right in this area here. So understand that this is playing out perfectly. My predictive modeling system, the advanced dynamic learning system, called this nearly 2-3 weeks ago. That it's just an incredible solution, and we still have potentially about 40 to 60% upside move in Bitcoin. So this is a very, very, wrong line. So from this level, we've got about 20% to 40% upside in Bitcoin, which is very, very likely to happen. I believe the 24 to 25,000 area in Bitcoin is almost a sure bet. And I hate to say it that way because it's never a sure bet, but I would say that you've got about a 60 to 70% chance of reaching that 24 to 25,000 area in Bitcoin. Now call it 28 to the 30,000 area, that's probably more along the lines of a 40 to 45% opportunity right now. Still relatively strong, but it's going to depend on what happens and how quickly speculative capital moves into this particular move. This could also buoy gold, silver, and all precious metals should this really start to move higher. This is a move to safety is what's happening here. Watching the dollar and foreign currencies potentially evaporate. This is a move to safety, away from risk in currencies. Okay, the next one will go, next part of this video will go over the other custom charts and spend some more time looking at the markets going forward. Good morning, ladies and gentlemen. Today is September 10th, Saturday. This is Brad Matheny. We're going into the more advanced section of the weekly market update. We're going to start here with the volume ratio index. This is a measure of upward volume versus downward volume. We continue to see moderate upward volume. We had a couple of bigger spikes here, a very big spike up above 20, which was bigger than the COVID recovery. This was 2019, the bottom of 2019 change, and this was the COVID recovery here. So we're looking for, if we're going to see any real upward momentum here or a Christmas rally, we're going to need to see a spike of this upward momentum up above 10, 11, or 12. Anything up above 8 would be moderately substantial. We've seen some fairly moderate trending here lately. We need to avoid something like this, which would be extended downturn. Change in direction, real weaker down volume, dominating over up volume. So right now we're hopeful that the market's going to continue to move higher. And remember, we're still playing out that pennant formation. So I expect it to kind of flag out and move sideways, possibly staying down below 7, 8, 9. Anything below, say, this area or this area is just real moderate upward trending. We're not seeing real solid upward strength. Next, we're going to go to the custom US devaluation trend index. This is a monthly chart. You can see here a little doji forming over here for the beginning of September. We're not seeing any real strength. And as you can see from this, this is an inverted chart. And August was very, very weak overall. September weakening, trying to hold support near the 217, 215 level. We're seeing some real weakness still in the market. We're not seeing any solid upward trending. You can see the downward trending we have here. And we're attempting, like I said, to flag out. You can see it. This is monthly. Draw a line across these highs, come down to here, across these lows over to here. We're really flagging out. I think we need to watch and stay cautious to see what the Fed's going to do, how they're going to push it, what global central banks are going to do, what China's going to do, what Russia's going to do as we move into the October-November timeframe. The U.S. markets might find some support and rally into a Christmas rally phase, but we're pretty much trading sideways. And I'll get to that in the charts here in a minute. A big, broad flagging formation. And we have no real trend indications yet. Next, we have the large cap index. Again, flagging out. This is a monthly chart. We've broken downward. This was the weakening trend in early 2022. We've moved into this sideways flagging formation. This is a pretty good sign that we could be attempting to form a bottom, but we've got to be very cautious of another leg downward. See here in 2012, we had an extended downward move. We had 2008, 9. This was our downward move with both the selling pressure. Large caps rallied through a lot of this because it was primarily the financial sector that was collapsing at this point. And then we had this broad market rally with very few downward trends. So we need to be cautious here, depending on what's going on. The U.S. markets are in a totally different world than the rest of the globe. So we may see large caps hold up fairly well, but we're just seeing no real strength yet in September. Next, we have the U.S. to custom global market index. This is a comparison of the U.S. to global market in red, U.S. in blue. We're seeing some upward strength here. Again, very clear kind of an A, B, C potential pattern here, but we're also in a broader A, B, C, D, E type of pattern to the downside, or possibly an A, B, 1, 2, 3, C. So we need to see how this plays out. This is our pennant formation very clearly off of these lows and across these highs. Then we can come down off of this low, cross this low, and draw another one. So we're in kind of a double pennant formation. I'll show that to you in a moment. We need to see how this plays out. The global markets are in a tightening downward spiral, and they're getting very close to coming down to this lower channel, this lower COVID channel, which I've highlighted many months ago as what may become ultimate support. So we'll see how this plays out. We may see the global markets move down into this one, call it, it's tough to say, but here's 140 post-market. I would say that we're likely going to be down into this 130. Well, this is, no, this is not inverted. So 130, 128. I'll look at the smart cash index real quick, give you a better number. I think that was it. Nope. Here we go. So yeah, that would be down in this 125 to 120 range. This is the smart cash index, the global smart cash index. It is the same index that we are seeing right here in red. So this would be about the 120 area down here near these lows. Global markets are much weaker than the U.S. market. We need to see how this plays out. Generally, trend is very weak right now, so there's no real opportunity. Custom global asset index is stalling out, very weak. This is a monthly chart. You can see September is a tiny little dot up there, small little doji near the low of the range. I'm very concerned that we're going to see some bigger, broader breakdown, but at the same point in time, I do sense that the U.S. market could see a bit of a Christmas rally, possibly rallying 5-10%, maybe a little more. But right now, we have no indication of this uptrend. Next, we are at the cycle trends. This is a longer-term chart that was produced a while back. Gold is struggling off of this area here, and we're really looking for gold to hold that 1700 level and begin to rally. So let me go back to here and move to the U.S. real estate conditions. U.S. real estate is cycling downward. Now let me zoom in on this a little bit. You can see the real estate trends as far as the price reduce count is starting to tick higher. The blue line back here is price, median listing price, which is moving slightly lower. Median days on market has flatlined and is kind of increasing ever so slowly. The price reduction share of market is ticking higher and higher very slowly. We have the active listing count is kind of flatlined and ticking slightly higher right now. Interest rates are going to move above 6% on a 30-year fixed mortgage. We're going to probably get to 6 3/4, maybe 6.5 on the next Fed rate increase. I see the market as shifting, just not necessarily having the bottom fall out of the market yet. My dynamic trend forecasting shows that demand is very low. Real price factor is at minus 33.41, and that is the blue line. And the dynamic modeled price market demand is at minus 46.84. That is the orange line. Demand picked up a little bit over the last couple of weeks, but really it's gotten very, very weak. You can see the peak up here, very strong demand. This was in early January. This is December. This is November of 2021, October. You can see demand shot up for houses while we were nearing the pre-Fed move, and price factor continued to shoot up. Price factor has weakened from approximately a plus 40, plus 44, down to a minus 33. So that means that we've come full circle. Essentially, price levels are, or should be, in a real price factor based on my modeling system, about minus 20 to minus 25% year over year right now, while demand is approximately minus 30 to minus 40% year over year on modeled demand. Now, the next phase of this will be the metrics chart, which is here. And the metrics chart shows us that real estate price trends are weaker. They are below zero and hovering below zero. We haven't seen any massive collapse yet, but real estate trends are weakening continually. We are not seeing any real demand, and now we're starting to see prices come in under offering price. So people are getting smart. They're bidding under the asking price, and that is now driving sellers to be fairly cautious about where they place the market. Look over here at price reduction activity. Price reduction activity has collapsed. You're not seeing a lot of reductions. But as far as share of market, you're still seeing roughly 85% share of market of price reductions. New real estate active listings have collapsed. You're not seeing a huge amount of new listings come on the market right now. It's down at minus 14%. So you're seeing that what's on the market is on the market. You're not seeing a huge amount of new listings. We're not seeing a flood of new inventory hit the market yet, but it's likely to come. So pay attention. As sellers get pushed into deep selling or forced selling, you're likely to see new listings start to skyrocket. And as far as new listing count metrics, you're seeing the new listing counts at 26.7% based on my metrics. So again, we're still seeing moderately strong new listing count. It's just the measure of new listing counts has continued to drop. And you can see this back up, and I'll go to the other chart here. You can see it right here. So when you take a look at new listings, okay, active listing count, you can see has moved up. That's the orange line. Move it back here. Active listing count has moved up considerably. That's where we're seeing the increase at 26% on my metrics. But recently, new listings coming into the market have actually decreased. So what we're seeing on this chart is it's showing us that new listings are increasing slightly. Total active listing counts have increased. New count change has come down, meaning we're not seeing the same number of new listings hit the market. We still have a fairly strong block of new listings that are in the market over the last 8 to 12 months, but new listing share of market is moved down. So we're seeing that the new listings are actually contracting. Homes are moving off the market slightly right now, and that's because we're seeing essentially sellers. You can see here, new listing count is elevated. New listing count change in orange is coming down. So you can see how it's moved into negative flat down territory. New listing share of market is down minus 0.94. So it's decreasing. New listings do not appear to be slamming into the market right now. This I expect to change. I expect you're going to see a huge amount of new listings come in through November, December, January, February, as people really try to dump houses, and you're going to start to see you're going to start to see price reductions come down quite a bit. Next, okay, let's go to the TT scanner. TT scanner is unchanged. It's really quite unusual. We're starting to see some accumulation. You see this down here. We've got accumulation in IXN, accumulation in QQQ, accumulation in IYC, consumer discretionary. We've got in banking, KBE, ITB, which is home construction, IYG. Be very cautious of this right now. This is accumulation into a sideways trending market. We don't have any real trending activity going on right now. We are still, metals are bearish. Energy is still bullish, just like last week. We have to be very, very cautious of how things are going to move going forward. We're not seeing any trend change. We're seeing some accumulation, but like I said, I would not chase these trends right now. Even though there may be a Christmas rally, we don't have any real breakout. The pennant formation is still going to play out. Okay, so now we are at the TT Scanner Core hot list. This is a weekly hot list of the core ETFs. You can see we are short for 18 weeks on ARKW. We have hit none of the targets yet, but we are 14% in profit. Last trade was at 54, so we're very close to the targets, but we haven't gotten there yet. We have got new trades here, none of which are new. XLE is long. DBA, which is the agriculture sector, is long. This has been for 72 weeks. We've hit both targets. We have MJ is short for 17 weeks, hit one target. XOP is long for 30 weeks, have hit both targets. GDX miners is short 9 weeks. We've hit no targets, still got 9% in the profits. UUP, the dollar, is bullish for 21 weeks long. We've got 9% profit. We've hit both targets already. UGL, which is ProShares Ultra Gold, is short. We are 2.53% profit. We have not hit any targets yet. And UUP, which is in here duplicated, forgot to get rid of that, is just a duplication of this previous trigger. Now, the core inverted list, we have one new trigger, which is a bear energy, ERY. Daily energy bear 2x shares. We've got a new short trigger. We are minus 0.21% profit. This is very interesting because ERY with a new bear trigger indicates that oil and gas and the energy sector may be moving into a very solid downward trend. We also have DRIP, which is oil gas exploration, 2x bear. Short trigger 1 week ago. We're minus 4.75%. We haven't hit any of the targets yet. Looks like this one target is negative. We need to ignore that. But long and short of it, bear sector is moving in, energy and oil production are moving into these early inverse stage short positions, meaning that, so we've got a bear short. This would normally be going up if it were in a downtrend. So this is potentially actually telling us bear short. So yeah, these are actually telling us we may see some upward move here. Ultra shares, MSCI emerging market long, 20 weeks, 10%. We've already hit our 15% target. Our first profit target at 15. Next, we'll go to the value hot list. This was added about 3 weeks ago. We got a couple of new triggers. We have a new trigger here in Dow, which is a short trigger. We have a flat trigger here in SMG, Scott's Miracle-Gro. Otherwise, we're continuing here. We've got 30, let me zoom in here, 35 weeks long for Chevron. We've already, 36% profit target. We've already hit both profit targets, or 36% profit in trade. We've got 1 week here in WBA. Let me move this over here and shrink this a little. Oop, wrong one. Okay, got it fit in there a little bit better. So we've got the new trigger in Dow, 1 week trigger here in WBA, Walgreens Boot Alliance. We've got minus 0.81%, haven't hit any targets. 10 weeks here in Intel, INTC. We've already hit the first target, 19% profit is a short. And we've got a short trigger here in Verizon for 4 weeks ago, 6.03% profit target. We've already hit the first profit target of 41.27. We also have a long down here in UNH, 73 weeks, very long trigger. We're at 40.02% profit target or profit in trade. We've already hit both profit targets. Remember, when you're looking through these stocks, what you're considering at this point in the value list, for example, we've got a WBA, Walgreens Boot Alliance as 1 week old. This one is brand new for the Dow, Dow Inc. And don't worry too much about these negatives. What you're focusing on here, this is a short trigger. You want to pay attention to the thrusting pattern, and you want to pay attention to potentially this lower range. You've got to be close, ideally close to zero. So below, hypothetically, 0.5, 0.4 would be very, very good, in my opinion. So when we're looking at something like this, where we have a short in the Verizon, in the Walgreens, so we're in a neutral trending mode with a 1.42. Okay, this could turn into a solid trade here. We need to see this move more into red. This is more of a neutral trigger here, kind of flat, telling us that we're not seeing any real trending. So this is moderate low volatility. Profit factor is fairly strong over here, 3.75. So this may turn into a very good trade, very low risk trade here. 1 week into it, off only minus 0.8%, meaning that we're kind of flat, not going anywhere. Good profit factor, and it's really probably a low risk trade. Whereas this one is a brand new trigger. We're off 1.22% from our entry. It's a new short. We haven't hit our profit targets. It is trending downward. It isn't trending overly excessive. It's not a negative 20, negative 30, negative 40. But when you look over here, 0.50 profit factor and 0.27 profit factor versus win rate, we don't have a high degree of success with this. So this would be very likely to see a moderate downside move, meaning I would look to take my first profit target, probably pull 60, 70% off at that point, and try to let the rest trail. So we have the flat trigger here in Scott's Miracle-Gro, and we have no other new triggers other than this one in Verizon. Verizon's already hit the first profit target. We've got about 6% profit here. Yep, 6.03. It is trending downward with the thrust pattern fairly strongly. So depending on where we're at with the trade, we're at 42.24 right now, just above this target. You do have a pretty good chance with this downward thrusting of reaching the next downward target, 37.69, fairly quickly. Stop is at 43.49, so that's a low risk trade. You've got essentially a 42.24 current price, stop at 43.49. We've got downward trending. You basically at this point, ladies and gentlemen, this would be a fairly low risk trade for about a $5 profit with about a $1 risk. You are in downward trending. This could be a very good trade for a small portion of your portfolio. And that's the way I look at it. I take a look at where the stock is, where the next target is, where my stop level is, where thrust is telling me, and you can see here, profit factor here is 0.55, and the win ratio is 1.13, meaning that we have a fairly high win ratio, and profit factor is moderate. When we look at the low, again, with the 1.13 profit factor, this tells us that we're generally 1-to-1 win to loss ratio, and a profit factor tells us that we're moderately positive. We definitely want to stay from anything negative or extremely low profit factor. So this 0.88 is good. Up here with the Dow is 0.27, means we have a very low profit factor and a very low win-loss ratio. So this is more of a negligible trade. Just look for the first target, maybe half of the first target from where we're at. We're at 50.51, 43.78. So possibly maybe in the 45, 46 range. Pull your profit, call it good, and leave a small trailer with a trailing stop. Okay, let's go over to the, we've covered almost everything. Let's go to the general market again. This is the SPY daily, and I've changed the color on the chart so you can see the bars a little better. But we are in this broad sideways flagging formation. You can see we've come down A, B, C, and then possibly with an A, B, C move down here to find the formal wave C. If we count this as a first wave, this looking like a second wave, possibly coming back up into this area, the 423, 424 area, trying to find some resistance over here. We could see this rally up and continue to flag out here before attempting to move downward or upward. This is really a very interesting sideways flag, and it really depends on what's going on in the global markets, what's going on with the Fed. If the Fed moves softer on the 20th and 21st, then we could see the markets really attempt to rally and start to move into a Christmas rally. This would be really the October, end of September, early October timeframe to build momentum for potentially a Christmas rally back up into this area, 454, 455 area. If global markets, European energy crisis, European markets, and Chinese markets and Asian markets collapse because of COVID or energy concerns or what have you, then we could see a bit of a rush into the U.S. markets for safety, but overall that could really stall out not only U.S. markets but global markets and could push us into a broader market decline. Imagine inflationary trends are still difficult. The Fed's trying to fight it, while China, Russia, and Europe move into a broad stagflation, meaning inflationary trends are still there with energy, with products, and Europe and China and what have you move into a broad, let's call it economic stalling phase, which is what's warning is going to happen in Europe. Higher energy prices may push the European Union into an absolute economic meltdown. And when I say a meltdown, they are literally just going to have to close shop. They cannot continue to produce, deliver, support. Even local shops may be forced to just close shop simply because they cannot afford to deal with the energy costs the way things are. So the next 20 or 30 days could be very telling. The pennant formation, the way I'm seeing it, looks like it's going to be right around here. Early end of September, after the Fed, early October, we start moving into some very tight ranging, and this is when I expect we're going to see either a big breakout to the upside, really launching us into a Christmas rally, or a potential massive global contagion sending us to the downside. And it really is going to depend on what happens here pretty much end of September, early October. So right now, if we take a look at gold and silver, gold is trying to hold very tightly around this 1700 level. This is a weekly chart, remember. This is from my drawings earlier. I still see gold as being a very solid safe haven play. I mean, we take a look here, ladies and gentlemen, and you can see the broader picture. Okay, we've had this massive wave here up through the 2004, 5, 6, all the way up to 2011. Come back down to an end phase here, rallied back up here. Now this is the unwinding of COVID and the markets through the excessive speculative phase. I see gold as an essential safe haven. The risk involved in holding a gold stock and or physical gold at this level is in my opinion worth it, for the simple reason that the safety provided, knowing that you're not going to have to buy excessive premium when the crap hits the fan, If gold is trading at 2,000 and the crap's hitting the fan, you're going to be paying a 10% premium. You're going to be buying it at 2,200, 2,300, maybe 2,400. Same thing with silver. Silver spot is 1878, and unless you know someone, you're going to be hard pressed to try to find someone selling you silver for less than $22 to $23 an ounce right now for single ounce bars. You start buying bigger bars, you might get it closer down to $19, $20, $21 an ounce. But in reality, silver was trading back down here at 17, 18. Well, let me take a look here. If I remember right, just recently, yeah, 1752 roughly an ounce spot, but you couldn't buy it for less than $21 to $22 an ounce. That's a $5 premium. That's almost a 30% premium on silver. So this is a great opportunity right now. You can see silver's forming this broad pennant formation as well. And silver, the pennant actually apexes out here in August of 2023, June, July, August. So we're really looking at maybe silver moving within this range until 2022, 2023, and potentially breaking out earlier, whereas gold's forming a very solid pennant right now. So you could see here this pennant formation really starts to channel here. Okay, now we could take a look at broader trends. So for example, we could come off of these lows, try to come off of these lows over here, and potentially come across these highs, back over here, and tell us, okay, now we have a broader channel setting up with regards to price, which may move us out into the August, September, October time frame potentially for a channel. But we've got this immediate price channel here in gold, which I believe is going to send gold skyrocketing back up into this area, 1950, 1970, and then potentially forming a new pattern up here. I believe ideally what's going to happen here, ladies and gentlemen, is you're going to see gold rally up off of these moves and form a tightening pennant up off of this channel, this upper channel here. So something more along the lines of rally up off of this, come back down, rally, come back down, and then break out. So I know this is kind of complicated here. Let me see if I can get rid of some of these. Nope, I want that. Get rid of that. Get rid of that. So this is kind of where I see where we're at. This rally phase off of this apex, rallying up to this level here, 1934 to 1960, let's call it. And then moving back down here to support around 1832, coming back into here to form another pennant, and then eventually breaking out. And this moves our breakout around May 2023, which would potentially indicate that the SPY and the regular market, let me come down here to the SSO. This is the Ultra Utility S&P 500 Ultra. So really what we're looking at here is the pennant. I'm trying to draw this on something that has different channels. So you can see there's our downward flag. Here is our upward flag from the COVID lows off of these lows. Okay, so let me come in here, redraw this. So there's our generic flagging formation setup, right? Very easy to see that we're in this flagging formation. As long as we stay in this channel, it's going to continue to flag out. If we see this move upward, what would happen in this case is we would move into an upward channel, come back down, upward channel, come back down, and then potentially break out. And that would put us into a channel line kind of like this across these levels here, and potentially across these levels here. And this is the next channel I expect to see form. Moving sideways, moving into a sideways channel, breaking out of this channel, which is going to get everybody into a bull trap very quickly right over in this area. Everybody's going to be like, buy, buy, buy. Look, we've broken this upward channel. And reality is it's going to form a secondary flag formation until possibly February, March, April. And this is where we're starting to look for a real broad trend. So understand that in this area, right in here, this is where we're going to start to see some real excitement. And that's going to be the beginning of 2023. That's when we're going to see whether or not the Fed has broken inflation, whether Europe has survived the winter, whether China has survived their COVID and financial collapse related to their global markets. So we're looking at really sideways trending for the next 2 or 3 months. Maybe a bit of a Christmas rally, but more so sideways trending. So this sideways rally phase I indicated here, it could be more of a upward pennant formation like this. Up, down, potentially higher. So that would be a pennant formation like this across this channel here. I'm going to try to draw that as a different color. So maybe more pinkish. Okay, and then we draw another one from here. And that would be kind of like this. A little more pinkish. Close enough. So we have two separate channel types. We have the sideways yellow channel here. And let me make this the pinkish color. And let me make this I'm going to make this more of a greenish color. Yeah, greenish blue. Okay, that works. And we'll make this more of that bluish color. And make this more of that bluish color. So we have two separate channel formations setting up. The blue moves us into a sideways flagging channel out to here, and the pink moves us into an upward flag channel setting up into here. And make this the pinkish color and the pinkish color. And that's ultimately, ladies and gentlemen, where the market is going to go, in my opinion, over the next 4 to 6 months. So we have a long way of sideways channeling before we get into the new year. Remember, this is January right here. I will mark January right there. That's the beginning of the new year. And that's where we're looking as a very critical area for our interpretation. I don't expect to see any major opportunity in the markets until after Christmas, and that means likely January 15th through January 30th, we will be starting some new trend. Until then, we are going to be flagging within a range, and remember, this range from peak to bottom is 18% on SSO. That'd make it around 6 to 7% on the SPY. And from this range, blue down to here, 13%, possibly 15%. So that would make it about 5 to 7, let's say, percent on the SPY. This is the SSO, the Ultra Pro Shares SPY 500 index. So we could trade this SSO for, let's call it 6 to 12% within these ranges. But we need to be aware that we're at a bottom range here. We're likely going to see some sort of a rally, possibly a relief rally after the Fed up into this area, 57, 56, 96. If it moves off to this channel, We could see it around 59.75, but this gives us an opportunity here for about 11% upward move. I would say call it 8 to 10% would be really your immediate target. And then the Fed is likely going to move into moderate aggressive rate hikes through the end of the year. We could see Christmas rally move into this kind of a channel between this blue channel and this pink channel, staying within these orange lines here. You can see how these orange lines, which remember I drew these from way back here, from these channels back here, went a little too far, 2019 lows. That's pretty much where we're at, ladies and gentlemen. We're in this channel right now, and we're going to stay in that channel until January or February, when we're likely to start a new trend and see what the world looks like after the end of 2022. All right, that's it for now. A little long, but very detailed. I'm showing you 6 months out what to expect. Where else can you get this? Follow me on Twitter. Follow me on YouTube. Share with your friends, please. I want to help as many people as possible. We're going to stay properly hedged through the rest of this. We may see some surprises, but generally I think it's going to be fairly calm going forward. All right, guys. Thanks a lot. See you soon.